Welcome to another episode of Anyone Have a Pencil? Today we're in Las Vegas, Nevada at the beautiful Wynn Resort, and my guest is a friend, a business partner, and head portfolio manager for Ignite Funding, Pat Vassar. Pat, welcome.
Pleasure to be here.
How's it going, dude?
It's going.
Yeah?
Welcome to my city.
This used to be our city.
That's true.
And now I guess it is yours.
Yeah.
So just had a baby.
Correct.
How's that falling into the plans for life right now?
You know, life is one thing you set out and have a direct course. And as Mike Tyson likes to say, you always have a game plan until you get punched in the face.
So having another baby is like
it's just another punch in the face. So you have to deviate from what you're expecting, your goals for the immediate future, and kind of reassess where you're at and kind of re-strategize going forward. So that's what we're doing right now. You know, we're only a week in and just kind of figuring it out.
I love it. Well, thanks for making some time for us. I mean, I think one thing that I've noticed with entrepreneurs and, you know, high level performers is they have a tendency to fall out of balance, you know, in their life. How do you manage, you know, your career and starting a family, bringing babies into the world? How do you, what's changed for you and how are you balancing that out?
Well, as you know, as the saying goes, there's only so many hours in a day. We all have the exact same amount of time within a day, and it's just how you utilize that time. It's a give and take. You know, you give away on some aspects of your life, and you get gratification in others. I used to be extremely into, you know, fitness and health, and that kind of has wavered a little bit too much. But that'll, you know, it's an ebb and flow. It'll come back around, and you just kind of learn to roll with the punches, so to speak.
Yeah. What's the biggest thing that changed for you when you became a dad for the first time, like in your career, just like life-wise? What switch went on?
Well, I would say the biggest switch happened when the pregnancy test came through. That was my biggest switch, and then probably a year into it. So when that first pregnancy test came through and Andrea told me she was pregnant, I sat there just dumbfounded for probably, I don't know how long it was, but probably an absurd amount of time.
It was for the first year.
Yeah, there was a lot of thoughts running through my head, and I don't know exactly what all that was. Is, am I ready for this? Can I do this? Am I going to be good enough for this? Like, am I capable? Like, what is going on? What does this entail? And as my old man once told me, if you're waiting to have a kid until you're ready, you'll never have a kid. Yeah. There's just something that changes, something that's just kind of ingrained in you that says, you know, game on. And that's exactly what it was, right? It's something we had planned for, something we wanted, something we knew was coming. But until that pregnancy test stick hits you, it becomes real. And then fast forward a year into it, I don't know about you and your experiences, but being a dad for the first 6 months, 9 months, year, whatever it was, is kind of a, you know, I feel like I'm more of a liability than an asset. I feel like I'm more of a detriment to the mother and child's experience, which I think is very, very important. And so that first 6, 9, 12 months, whatever it was a time that I was trying to figure things out. Like, where do I fit in this whole role? Yeah. Like, I'm not.
Yeah, they want nothing to do with you for like the first 6 months.
Nothing. And the kid, you know, is just sitting there, you know, eating, breathing, going to the bathroom, and wanting its mom. That's about it, right? Yeah. And during that time, I had a lot of time to reflect, saying, you know, where do I fit in here? Where do I want this going forward? Obviously, I'm going to have a kid. I'm not saying that. I'm just saying, do I want more of this? Yeah. Do I want this to be the centerpiece of my life? How does this all fit in? What do I need to give up? What do I need to change? And so it took me probably a year before I kind of figured that out and kind of got in a groove of it.
Yeah, I agree with that. I think I'm still adjusting. I think one of the biggest changes is that your selfishness has to be gone, right? You can't afford to be selfish. It took me a while to kind of adjust to that, especially just being, you know, driven in my career and things that I wanted to accomplish, or even just things that I wanted to do, and like putting that in the background. And I think my friend Steven said this probably the best, is that it really comes down to like embrace the suck. Like your job as the man is like you said, for the first 6 months, like you're waking up in the middle of the night to change a diaper and let your wife sleep because she's exhausted.
Right.
And then, stay out of the way. Yeah. And it's like, oh, you're tired. No one cares. Your kids don't want to be around you. They're screaming all night. No one cares. Your job is to be the consistent, backbone during that time.
No doubt about that.
Takes a big adjustment.
It does. Well, at least it did for me. I don't know if that's the normal way around it, but I don't know if there is a real normal, right?
I think most fathers feel that way, man. I mean, unless you there's no way that it can't be like that. Your kid's just attached to the mom for the first, basically year. So, and then they start talking and walking, and then you're fun.
Yeah.
And you picking your kid up and throwing them in the air, gives them all of the endorphin releases that, they cherish as a kid, and then they get attached to dad.
Yep.
So it just, just a little adjustment period.
It's the ebb and flow, right? That's what it's all about, really.
Well, and most people, won't know this, but Pat and I have been friends for 15 years. We've invested together. We've worked together. He's the godfather to my oldest, Charlotte. So, we have
same on the other side.
Yeah.
Not my oldest, second oldest.
Yeah.
The daughter. Had to wait until the first girl came in on my side before you got that.
That's true. Yeah. Well, I'm 3 for 3 girls. So we were just in order. So tell everybody a little bit about your background, because you have an interesting story about kind of your I guess, mission and how that kind of has adjusted and getting into real estate. So how did you find that you wanted to be in real estate in the first place? Because you were a little bit different than me. Where in college, you were kind of focusing on that way early on. So tell us about that.
No doubt. I was kind of a one-track mind, to be honest with you. The first time that really happened was probably freshman year of college. I went to the University of Colorado. During that time, I had started in mechanical engineering, quickly realized that was not going to be for me. Switched over to business and then thought I was going to be a stockbroker, thinking maybe a personal, financial planner or advisor of some role might be the way to go. I took one real estate class and fell in love with the tangible aspect of real estate. And ever since then, I've been just kind of got my blinders on and just been singularly focused on that. Everything I've done has been with that real estate centric. Everything that I'm going to do has been real estate centric. That's just who I am, what I love doing. And as they say, once you find a career that you love doing, you'll never really have a job in life. Yeah. And, I don't work a day in my life because of that.
Yeah, you enjoy what you do. So why the tangible aspect of real estate? Why was that the thing that kind of switched in your head? Instead of, you could be a day trader trading stocks, you could be an analytics guy for, a huge firm. You're being very humble, but you're very credentialed in your education. Correct me if I'm wrong, but didn't you get a scholarship to go to Stanford for a doctorate in economics or something like that?
Not a doctorate, but yes.
Another master's
degree?
Another
master's degree, yeah. I didn't want to do that. That was after I went to the University of Denver to get a master's degree in real estate. Thought that was going to be enough and didn't want to pursue that any further. I kind of regret that to a certain extent, but I wouldn't be here where I am right now if I had done that. Would have been somewhere else. I don't know if that would have been better or worse, but I can't go back and say if it was a good or bad decision.
But your credentials would give you kind of the pick of the litter. You could have gone into stocks. You could have, you could have done a lot of different things. So why real estate? Why was there an experience? Because your hands aren't on real estate in school, right? You're literally sitting there doing the same thing everyone's doing, which is reading and doing math. So what was it that switched that for you?
No, it truly was the tangible aspect of it. So it's kind of hard to get your mind around owning 1/10 of 1/100th of 1% of Microsoft. It's a little easier to say, I own this house. I own half of this commercial building. When you see it and you can feel it, it becomes a lot more easy to understand, in my opinion. It becomes more personalized and one in which you can really feel as though you were making a difference. Or if you were just owning a piece of a corporation, to me, you're kind of running along. You're riding someone else's coattails. You might be able to pick some winners, pick a great dog in the race, but I prefer to be the dog in the race. I prefer to be the one out finding deals, be the one out acquiring assets.
So you like the control. Because that's one thing about real estate that I enjoy too, is like, yes, it's tangible. Everyone understands the idea of owning property, right? Everyone owns a house for the most part, or has lived in a house, right? So that's easy, connect the dot. But being in control where you're not one millionth, owner of some stock, and you get to be the decision maker for that property,
right?
For the most part, right? Like I get to buy land, I get to decide what to build on it, or how to develop it, or when to sell it.
Sure.
Whereas you own Microsoft, you're not in control of anything unless you own enough shares that your vote matters to them.
Right. And good luck with that. To your point, it's riding that person's coattails, right? I guess another way to put it is being in control of it. You're creating your own destiny as opposed to riding someone else's coattails and following their destiny.
And now you're riding developers' coattails.
To a certain extent, yes. However, in our line of work, you're more hands-on than that. It's more than just a lender-borrower relationship. It becomes a partnership. It really becomes something in which the lender and the borrower facilitate to make a community, to make a new building.
Let's talk about that really quick for a second, because we didn't really introduce that of like what you're doing now, right? So correct me if I'm wrong, but originally, before you started as a portfolio manager for Ignite, weren't you involved in development somehow or commercial brokerage? What was before that?
So after college, I got into commercial sales. I was a real estate broker, working for a large company in Metro Denver, selling medical office buildings. That lasted a few years before I went back to grad school. Stayed there, and then a little bit during and after grad school, I got involved with, which was the third largest industrial REIT. They were doing big boxes all across the country. My primary markets were Denver, the Inland Empire, Las Vegas, and Calgary, looking at new acquisitions, new developments, new property to buy, whether if it was already constructed or a land deal to go vertical on.
So you're kind of playing developer at that point with REIT money, right?
No doubt.
You're part of the acquisition team, development. What do I do with this piece of dirt to provide a return to the fund?
Absolutely.
Right? Okay, so kind of tell everybody what Ignite Funding is and what your role is within that company.
Ignite Funding is a hard money lender. I use that term kind of tongue in cheek. It typically comes with some negative connotations associated with it. So we're private lending. We are crowdsourced lending before that became kind of a catchword. We've been doing that for quite some time. That pools investors' money together, invest into real estate projects so you can be part of real estate without having the day-to-day duties of it.
Sure. And I mean, my favorite part about that, and just full disclosure, Pat and I used to work together, and also I've been an investor with your company before, and I will continue to be in the future as well. But the thing that I find fascinating about that, and the way I would describe it, is like it really puts you in the position of the bank as the investor. So Absolutely. You're lending your money out through someone like Pat. You get a senior lien position most of the time on a tangible asset, in this case being real estate, so same as the bank. And in return for that, you're getting a coupon rate, right? So typically, what are your rates of return right now?
Usually right around 10, 11, 12%, somewhere in that range.
And then if the borrower defaults, Pat's job is to protect your investment by foreclosing on that or selling it, deed in lieu of foreclosure, right?
Absolutely.
And returning the principal back to the investor.
That's right.
So why that business, and what drew you to that in the first place?
I can't say I was really drawn to it per se. It just kind of fell in my lap. The reason I moved out to Las Vegas originally from Colorado was to work with a different REIT, a different group that was taking back assets. Moved out here in 2009, and I don't know if you remember back that far, but that was not the best time to be in real estate. That was a time in which...
good time to have cash.
It was a great time to have cash, absolutely. Yeah. And so it was an interesting period of time. I came out and worked with a group to help them get rid of a lot of assets. The person who runs Ignite Funding now, Carrie Cook, hired me to come on board with her to hopefully help her not get in that situation again. So far, so good, and we'll continue to kind of move down that route.
I love that. So, hard money does have a negative connotation to it, for whatever reason. It's like, payday loan centers, negative connotation, whatever. But the real advantage and the beauty of what you do, and the reason that my company works with you and Ignite Funding, is because you provide the ability to act extremely fast in a market that's changing, I think maybe faster than it ever has, right? COVID, coming out of COVID, interest rate adjustments, inflation, all of those things happening over like a very condensed period of time. You have to have some dry powder in order to take advantage of some of these properties. So the benefit for my company using a company like Ignite is I can call you and say, hey, I need to close on this deal in 30 days, right? And having access to that, as long as the deal makes sense, gives me an advantage in the marketplace. The other piece is you have to be able to get out of that quickly, right? So you're not a long-term solution for a loan. You're not a 30-year lender that comes in and says, yeah, I'll amortize your debt for 30 years, right? Sure. You're making a higher return, right? But let's say you're charging me 12% interest. What's an interest rate at a commercial bank right now?
Not too much. Not too much different.
Yeah, I mean, it's close. So your margin, your business has to have adjusted insanely because of that, right? Your spread between traditional bank financing, commercial, and hard money that has a negative connotation has never been lower, right? In the last 10 years.
Not in the past 2 decades, that's for sure. You bring up a great point. The reason we exist to begin with is the speed, ease, and convenience in which we lend money. Period. That's solely it. And if we are the best in breed of speed, ease, and convenience, we'll have a lot of borrowers coming to us. To your point, as the Fed has increased interest rate, as the prevailing tailwinds of the global economy and local economy have increased, with inflation taking its part and everything else, what you're getting at the bank, to your point, isn't that much different than what you'd be getting at a hard money lender. Because of that, we've seen a huge influx of borrowers. So what does that mean for Ignite? What does that mean for somebody that's in charge of figuring out what borrowers to go to? Well, that means you get the cream of the crop. You get the pick of the litter. Before, if you were charging anything more than what a bank was, there'll be somebody out there that says, you know what, I'll spend the extra time, work with the bank, and cut 50 basis points, 100 basis points off my deal. As that differential between what a bank charges and what we as a private lender charge increase, there'll be more and more people that say, you know what, yes, you are fast. Yes, it is easy dealing with you, but 500 basis points, 5% interest is too much. I'm going to go work with a bank. I will spend the 3-6 months it takes to get a deal financed. As that differential compresses, we see a lot more borrowers come to us. Right now, that delta is very small, so we see a lot of borrowers come to us, which is great, right? It keeps although we haven't increased interest rates much, if any, what it has done is allowed us to reduce our overall risk by going to more qualified, institutional quality borrowers that aren't utilizing hard money as a last resort or only utilizing them because they couldn't find money elsewhere. We are truly getting the cream of the crop.
Yeah, the cream of the crop of borrowers and also the cream of the crop of deal flow. So those, the reason they're the cream of the crop borrower is because typically they have a long history of bringing great deals that don't lose, right? You're not putting yourself in a situation where it's over levered and you have an asset that you can't exit. So explain a little bit why it's more convenient. So to me, I mean, I can explain it as a borrower, as a real estate developer, but from your aspect, why is it more convenient than dealing with the bank? And I'll tell you what my opinion is. First is that I think it boils down to how well you understand the business. Number one, you have a developer's mind that bankers don't have, and you can adjust to markets that banks can't. The banks are going to be 6 to 18 months behind you whenever something changes in the market, because they're like turning a cruise ship around whenever you have to make a decision. Their loan committee, their corporate office, whatever it is, just doesn't adjust. They don't understand. They only understand banking, not the development aspect. So how do you see it from your point of view?
I mean, I can really say it much better than that. Really what it boils down to is being a real estate professional in the mortgage industry. We can talk the lingo, we walk the walk, we've been there, we do that. And so to your point, we aren't bankers. We aren't somebody that has come from the corporate side of things or coming from financing or banking in general. Everything on my side of the company is very real estate centric. It is very oriented towards being a developer, towards being an asset owner and being in the real estate industry. So when somebody asks, what do you do? I say I'm in real estate. I don't say I'm in lending, because although we are, and although I am, really our key is to be in real estate. We are you. We are one and the same. And so we really take a joint venture type of mindset into it. Would we want to be in business with these people? Would we want to do a deal together? And we're going to be with them through the life cycle of this project. That may be 6 months to 2 years or so. Is this a group that we want to hitch our wagon to? So that component definitely gives us an edge. I would say another part that gives us an edge over a bank or many other private investors is we are nimble enough to move in and out of markets, in and out of asset classes, and ultimately in and out of borrowers as the market changes. To what you said earlier, I don't know if there has been a different time that things have been moving this quickly, that have been this systematic and widespread changes that really has affected an entire industry. Because of that, we want to be able to stay on top of our game. We'll move into markets that people are moving into. As the old adage goes, commercial follows rooftops. We want to go into markets that have people moving into it. Rising tide raises all boats, and so we want to be in those markets that have a lot of net migration going to it. A lot of that right now has been in the south or the Sun Belt areas, and we will continue to do that, whether it is moving into markets or moving into or out of asset classes.
And so asset classes, and you can correct me here too, but you're not only just doing development loans. So I'm a single family residential developer. Everything we do is build for rent. That's one asset class. You're doing dirt, land development, commercial, residential. What else? Missing any other asset classes there?
Yes, you're missing every other asset class, right? We do anything that is backed by real estate. So that could be a casino, that could be a golf course, that could be a gas station, that could be a church. You name it. If you
lent to a church,
we've lent to churches, we've lent to oil fields, hunting grounds. Wow. A little bit of everything. As long as it's backed by real estate, we can get involved in it. We get deal flow all the time from different asset classes that doesn't necessarily fit with what we're looking for. However, we still underwrite it and see if it still makes sense.
So I want to talk about the market overall in just a minute, but specifically, that's such a wide variety. I mean, most banks, I don't know a lot of banks that do all of those asset classes, right?
Well, and that's the key, really. The reason they don't is because of the layered stack of corporate jargon and BS that you have to go through.
The bureaucracy of all of it.
It truly is. From the top down, they'll lay out and say, we want 30% of our portfolio in single family detached house, 30% of our portfolio in lots, and the remaining part of our portfolio in commercial. And because they have these generic buckets that they're trying to put deals into, it makes it a little bit hard, especially when it comes to a multi-use project. Under those type of formats, most banks will get involved, not because they're bad deals or riskier deals, because they just don't know where to put them.
They can't fit them in a box.
Does it go into my residential bucket? Does it go into my commercial bucket? Yeah. Is it retail or is it commercial? Is it apartments or is it built for rent? What are these? And if it doesn't fit perfectly in my box, I'm just going to say no because I can't get it done. For us, we'll take a completely different approach and we'll see if the deal makes sense. If the deal makes sense and it's a group that we have comfort in, then there might be a deal to be had. Every deal out there is one in which we will take a look at, and we take a look at thousands a year. I don't even know how many, but thousands in a year of projects all across the country and all different types of.
So how do you pick the deals that you do fund? Because you at that amount of deals, you've got to be turning away deals that you would do. Right. So how do you pick the borrower? How do you pick the deal?
Well, that's where the art comes into it, and not the science. The industry in which we operate is multifaceted and really comes down to two different things: the art and science of real estate. When it comes down to the science aspect of it, that's pretty cut and dry, right? It's just numbers. What LTV is it? What kind of credit score do they have? What type of history do they have? What's their exit strategy? Is it pre-sold? Is it spec? Have they done it before? Is this a new project for them? Is it a new market for them? They're very yes, no, quantitative amounts. The other side of it is the art part of it, which is which borrower is better than the next. If you bring in two borrowers that are competing for the same asset, which one is going to do better in the long run? That's kind of where the art comes into play. So when you ask, how do you pick that? That's a kind of a more of a feeling than anything else. One in which, I'm not the best at by any stretch of the imagination. So that's where I get the president of my company involved, and she helps vet out those borrowers. So
yeah. What do you look for in the borrower? Like, obviously the convenience of using you over a bank. I mean, when you go sit down at a bank, and banks have changed so much, there's not a lot of a relationship there anymore. It's basically, what do your balance sheets and P&Ls look like, and how much liquidity do you have sitting around that we could go after if you default? Right. Very, very, like you said, in the box, good credit. You've been doing it for 10 years. It's like rinse and repeat.
Right.
Okay. So when it comes down to that, right, you have the two borrowers. Let's say they have similar experience. Let's say they have similar P&Ls. What is the instinctual thing of, I like that borrower over the other one?
Well, the first thing comes down to, have they done it before? Here in the past 10 years, if you were involved in real estate, you probably did okay. You probably had successful deals. But what are you like when the tide turns? Sure. When it's not as easy to get out of a deal? What is it going to be like then? Have you been through the entire full market cycles before? Have you been in bad times?
Yep.
If so,
how many battle scars do you have?
Right. How was it handled previously? Yeah. During the great financial recession that took place a decade ago now, or more than a decade ago now, how did you get out of that? What did you do during that time? So we want to pick borrowers that have battle scars, as you've alluded to, and borrowers that will show their true colors when things turn south. Real easy to make money in real estate when things are doing well. It's very, very hard to get out of a deal when things turn south.
It's hard to be a professional for a long period of time in any market, right? Real estate, picking stocks, whatever. So in this market, like we were talking about, a lot of people have entered when the water's warm, 2.5% interest rates. Everyone's a developer. Everyone's a real estate agent. Everyone's a broker. And now you're separating the men from the boys. You're separating the professionals from the people that were just opportunistic with cheap money. So what are the professionals doing to prepare themselves in this marketplace?
I would say the biggest thing that we've seen is being a little smarter on the capital stack, not going into as much leverage as they once were. With the free money, 2.5% interest, although not free, it might as well be. It's about as cheap as you can get. It became one in which you were incentivized to borrow, incentivized to lever up as much as you possibly can. Right. Now that has changed.
And you're getting higher leverage.
Absolutely.
At that time too.
Cheaper money, higher leverage, higher NOIs because of it, and higher asset values. Because of the decoupling associated with cheaper money, higher leverage, now we started to see it come back to more normalized times. So because of that, I think there's been an influx of cash into deals. So there's been more equity in deals. And on top of that, the cash levels of our borrowers have never been higher. Right now is a time in which borrowers' cash on hand are in great positions on virtually all or most of our deals. There's obviously going to be a few here and there that pop up that wish you go back on and take the money back from the investor, from the borrower. Unfortunately, that's not how it works. We foreclose and take the asset back and go through it that way. With that said, the cash levels are at great positions right now. The borrower strength, because of the cash levels and because of the history, are in great positions. Most of our commercial borrowers are waiting for there to be a little bit more blood in the water, so to speak, waiting for their time to really come out. Because of our debt, because of the cost of our debt, everybody that we work with are value add developers, value add borrowers, whether that they're adding value by developing, by turning raw land into finished lots, or adding value by entitling property, adding value by increasing the occupancy, whatever the case may be, everybody, bar none, is adding value in some way, shape, or form. We are not a long-term solution. We are definitely a short-term solution. And because of that, and because of the mindset and who we typically attract, it has really changed how we lend money and how borrowers utilize that money.
Yeah, your exit strategy has to be crisp. It can't be, delay and pray, which is what a lot of bank people are doing right now with, assets that otherwise are, they're over levered. You talk about, office commercial, right? Mm-hmm. So I think BlackRock just the other day spent $500 million on a property in Chicago that they sold for like $70 million or something like that. Am I right on that?
I don't know about the numbers, but yeah, they took a big hit on that, no doubt about it. And your definition of delay and pray, that is kind of the mindset for most commercial lenders right now. For us particularly, anytime we get into a forbearance agreement with a borrower, is not a delay and pray strategy. It's just one in which they need a little bit more time. It is not one that we're going to cross our fingers, close our eyes, and hope something good comes about. There's always a very definitive outcome and a definitive track to get that property resolved. Sure. As far as exit strategy is concerned, to your point, most of the deals that we're getting involved with now aren't speculative. They aren't, a field of dreams mindset where if you build it, they will come. Sure. This is more of a definitive exit strategy with pre-sold homes or pre-leased office space, something like that, where the use of the property is more defined and therefore typically a lot easier to get out of.
Yeah, like the value's already been added, so to speak, as the plan is working itself out. But, you have a tenant in tow on a commercial building that you buy that's vacant, but hey, I have all these leases signed. That's the value that you're looking for. And to that point, I'm talking about that on, upcoming foreclosures. You said you had a lot of people, smart money is sidelining cash on commercial right now. And part of that, most people don't know this, but in the banking world, okay, if I give you $1 million for an asset, I lend you $1 million. On my books, that's $1 million asset as the bank. If I foreclose, I lose my $1 million asset and it now becomes $1 million liability on my books, correct?
Basically, yes.
So I'm avoiding essentially a $2 million swing from $1 million asset to $1 million liability, right? So most banks that are federally regulated try to avoid that wherever they can, which is a lot of this delay and pray. Hey, I think interest rates might come down again, or people are going back to work, so occupancy levels are going to go back up. We're going to get the leases. Just hang on, but I need you to extend my loan for 2 years at the same interest rate. Well, now they've already done that. That the chickens are coming home to roost. This is my perception of the market, right? I was at 5.5%. It was going to adjust to 8.5%. That would have crippled me in my cash flow. I've got the bank to agree to extend it at 5.5%, but now I have no choice. It's about to mature again. My extension is now going to be at 9%. Now what do we do? And so the banks are going to have to start foreclosing or some other version of that. What are you seeing in that marketplace, and how do you think that plays itself out?
All I've seen right now is the delay and pray strategy. Banks unwilling to move forward with the foreclosure. To your point, that asset changes on their balance sheet. It changes their reserve requirements associated with it. And because of that, they become a very capital intensive endeavor for them to foreclose upon. Not because of the cash outlay, but because of the reserve requirements, because of their federally insured designation. Because of that, they are definitely hesitant to move forward with foreclosure, and we haven't seen much, if any, of it right now. We're still at pre-pandemic lows on foreclosure rates on the single-family side of things. We have started to see an uptick on the commercial side, nowhere near where we were during the financial crash of 2005, 6, 7, 8 time frame. During that time, foreclosure rates, default rates, forbearance rates were way, way, way higher than they are now. I don't personally see any segment of real estate going into that, including the redheaded stepchild, which is office. Even that, although they're at historic vacancies right now, I still see a light at the end of the tunnel through reuse, repurposing of commercial office space.
I'm fascinated by that, because I do think that might be one of the largest shifts in the segment, just because COVID proved, a lot of companies are making people come back to work. And I think some numbers and statistics have shown that creates a more productive workplace. It's really easy it sounds good. Like, hey, just stay at work from home and we'll jump on a Zoom call, whatever. But productivity dropped like significantly during COVID, right? And now you're seeing come back to work, productivity is going back up. But I do think that there is going to be a large shift away from the demand for retail office space, right? Especially in these large metropolitan areas that are net negative in migration growth, right? So have you seen a repurpose of a building like that? And if so, what are they doing? What kind of strategy are they using with that? Because it's not like, I can't put in an industrial park, and make widgets in this office building, because it just doesn't have the load that would be able to carry that.
Right, absolutely. And what we've really seen is office in major urban areas are typically best locations, right? Office buildings historically in major urban cores, the downtowns have been bellwether assets for many banks and long-term holders of real estate. That's where they put money into, let it sit there, and it's the best, the safest return on investment. So there would be a tremendous amount of money put into the urban core. Right now, because of people moving out, because of demand fleeting, that the rates of return aren't great. It's no longer a safe haven part of real estate. Because of that is where more opportunistic people get involved. Where we have seen the most success is changing office building into apartments, into living quarters, whether that is apartments on the rental side or condos on the for sale side of things. Right now, I do expect more of that transition to happen. However, it will be a little slow, hard fought out battle. It is not easy to turn office into residential. You'd think it would because of the location. There's an apartment building right next door. It's at the same store, it's the same height. It looks about the same from the outside, but the interior structure of it is greatly different. And because of that, it takes a whole different approach. The electrical, the plumbing all need to be completely redone. Just thinking you can add a kitchen to it is completely different when you're putting in residential kitchens.
Absolutely. I mean, just the thickness of walls, fire rating, like you said, plumbing, electrical. I mean, all of that stuff you're basically gutting a building and redoing 60% of its MEPs.
Right. You absolutely are. And because of that, you need to be able to acquire it at an attractive basis. To acquire it at such an attractive basis means the previous owner or the previous lender is probably going to be taking a big haircut on it. We haven't seen that big haircut happen yet. I think it's coming. I don't know how much, but it's coming.
Well, the BlackRock deal is any indication, it's 25 cents on the dollar, which I don't know how much of that was a tax strategy for them. I actually think that they're relocating a lot. Have you read that they're looking at creating a Wall Street in Dallas?
No.
Yeah, BlackRock is trying to bring its own exchange to Dallas, which I think would be fascinating. I might be wrong on that. You can fact check me, but I read an article last week where because of the tax incentives of being a Texas corporation, right? And, high education, lots of colleges around, like you can kind of recreate an environment similar. And you've seen that in other, foreign countries. Dubai was Dublin. Didn't they move and exchange to Dublin? So you're starting to see people get a little bit creative. So I think that's kind of fascinating. But getting back to repurposing from office to residential, does that not worry you that, so population growth is down or the corporations moved, so less draw to downtown to actually have an office? Why would that be replaced by demand for living?
Well, because this isn't the first iteration of it. Before, pre World War I, everybody was kind of moving out of the urban core into the suburbs. That's where the migration was going. That's when crime started moving into the urban core. The population where people lived wasn't there anymore, so it had to be repurposed and changed into office, into retail, and all the living kind of moved outside of it.
You're saying like post-industrial revolution?
Yeah. Absolutely.
Urban expansion.
Absolutely. Yeah. Urbanization, turning a place like this, never even existed. When it did, it became just a little drop in the hat, so to speak. And then you see this huge expansion out of the urban core into cheaper places to live. Once that took place, then there was a revitalization of the urban core and people wanted to move back. All the biggest luxury towers were always built at the urban core. Best price per square foot on a rental rate side of things on apartments was always moving back to that urban core. So this isn't the first time we've seen shifts in people's demand of where they want to live, where they want to work, and where they want to play. It all comes down to a developer's ability to transition with the average day retail consumer. If they're able to do so, they'll be able to capitalize on that. The type of borrowers we historically have gone after are the ones that have been able to do that and will continue to do that.
Awesome. What markets are you seeing right now specifically that you're keeping an eye on and that are attractive to you?
We don't necessarily look for major metropolitan areas to get involved in.
Why not?
Because it's a zero-sum game. We want to be able to. Real estate is really me versus you. It is a seller versus a buyer. And when you're against big metropolitan areas, you have a lot of sophisticated money moving into there. And when you have a lot of money moving in, then the demand for your specific money becomes less.
Your advantage kind of goes away too.
It does. And so we want to be in markets in which we have the upper hand. We have the ability to lend out at better risk-adjusted returns than elsewhere. Major metropolitan areas historically haven't provided that, and I don't think will for the foreseeable future. So we're usually in secondary or tertiary markets where we believe there's a better risk-adjusted return available to our investors.
Give me a couple of markets that meet that.
Couple markets. So instead of Denver, Colorado Springs. Instead of Las Vegas, Henderson. Instead of Boise, Idaho, getting into Nampa. So although you are really close to these major metros, you're working on the outskirts of town that have better economic drivers. They're their own cities. They're their own enterprises. However, the drivers associated with real estate are more conducive to long-term value creation.
Gotcha. And, we talk about this like mass migration. How has that affected your business too? I mean, you see Tesla, SpaceX all leaving California. I mean, that's like the big headline. And for historically, that area was a real estate juggernaut.
Absolutely.
Right? I mean, if you look at the last 20 years and the returns that were created there through, technology, M&A, the amount of money being invested there, right? How is that reshaping the marketplace? And not just, the big movers like Tesla and stuff like that, but we've been successful developing in these tertiary markets as well, where you have like a Tyson's Foods leaves Chicago, right? And moves to Bentonville, Arkansas, and all of a sudden you have 5,000 employees moving to a new tertiary market. What are you seeing in that landscape shift, and how do you take advantage of that?
Well, to bring it back to the California aspect, we used to be licensed out in California to lend. We moved out of California 10-ish years ago. So I'd like to say Tesla followed our lead on that by getting out. So the first
Elon called you first and said, "Are you guys sure I should leave?"
Absolutely. So it's a market in which we no longer saw great risk-adjusted returns. There was better opportunities elsewhere. To your point of going into tertiary markets where huge job growth can be had by one employer moving to town, also has a detriment to it, because when that one employer moves out of town, it becomes kind of a boom and bust area. So we don't want to look for markets or micro economies that are solely driven off of one enterprise, whether that is defense contracting or oil and gas or poultry. We want to go into one that is more well diversified, where that they won't have as big of a swing of employment or big as a swing of occupancies in their real estate through one employment shift. With that said, the markets that we're going to have traditionally been on the Sun Belt and the South. We find more opportunities in those areas and have for the past few years. And in the future, it looks like that's probably where we're going to be going as well.
And is that a byproduct of business-friendly states? Is it Republican-run states? Is it better weather? I mean, it's obviously going to be a combination of all of that. But what do you think's driving that the most? Like, what is causing these mass migrations to these Sunbelt states and to the South?
I'm not an expert in the way the irrational human rationalizes movement of jobs and their overall economy, personal economy. With that said, we have seen a huge influx to those southern states. It has been out of blue and into red. It has been out of the north and into the south. It has been out of the east and into the west. Will that trend continue? Who knows? And if so, for how long? I don't know. I don't have a crystal ball. The reason we get involved in the short-term aspect of real estate is because we know better what's going to happen in the short run than we will in the long run. If you ask the weatherman what the weather is going to be in a year from now, his guess is as good as yours. If you ask him what it's going to be in an hour from now, his prediction is probably more accurate. He has the tools to know where the weather is coming from, what has historically happened when these weather patterns happen. So he knows for fairly high degree of certainty what it's going to be in an hour, less certain in a day, and definitely less certain in a week from now. But a year from now is a crapshoot. The way we realize and go through real estate is kind of the same. We don't know where things are going to settle out, where they're going to be in 5, 10, 15 years from now. All the deals we get involved with are in short term in nature for that very reason. We're more confident in knowing where things are going to be right now and where they're going to be tomorrow, and less certain of where they're going to be in a decade. So the shorter horizon that we operate in, the more accurate our assumptions are typically going to be.
Sure. And, from an investor standpoint, why choose Ignite Funding, and why entrust you to, because essentially, just to back up, if I'm playing the bank, right, I still have to have someone to allocate my capital towards the deal. And that's why I'm entrusting Pat Vassar with Ignite Funding to make that decision. What separates you from other hard money lenders or a REIT or, another debt fund? Why should I give you my money versus them?
Well, I think it's kind of twofold. One is, as we talked about, and what we'd like to see in our borrowers, I would assume investors want to see that in their investment arm of real estate. This isn't our first rodeo. This isn't our first cycle. We've been through the downturn before. We've been around this industry during the good times, the bad times, and the average times. And so we've seen it all the way through, and we know how to change and adapt towards that. So I would say that's probably the number one goal or number one reason. Secondly, when the cheap money was in place, the hard money was a great place for people to find return. And so a lot of money started to flood this market. Most brokers, most lenders haven't been through the bad times before. They've only seen it when the sun's been shining. As the old adage goes, banks are great at handing out umbrellas when the weather is nice and sunny, but as soon as it starts to rain, they ask for those umbrellas back. And that's the way banking has traditionally been. And that's the way hard money has traditionally been. So there's been a huge uptick in the number of lenders and the number of dollars chasing deals. And as soon as things turn, you're going to see a huge decrease in the number of people lending money and the number of dollars chasing deals. We've been it through before. We're going to be through it again. We're going to stick through it as we did before and do the exact same thing again. Because of that, the battle scars that we have endured previously will help us alleviate that in the future. Another reason would be we're not a blind pool. You don't have to entrust Pat Vassar. You don't have to entrust Ignite Funding. You entrust the deals in which you get involved in. We put out an option for you. We'll always have a multitude of deals available, but you as the individual investor get to dictate where that money goes. You don't have to rely on me. You don't have to rely on the ebbs and flows of where we want to be, what markets, what asset classes, what life stage of the life cycle. You as the investor gets to dictate that. You become your own portfolio manager. Yep. It's that control aspect that our investors typically like. So they don't have to rely on me. Yep. They may not like any deals we're doing or very few of the deals we're doing, which is all good and fine. They wait for the deals they want to get involved in and go on those specifically.
I think that's such a unique aspect of what you guys do too, is just the ability to have some discernment over, I'd like my money to go towards this deal and not, like you said, a blind pool where, okay, well, I don't have any control over that. And another aspect of that is the liquidity and how long my money is going to be tied up. So if I go to a REIT or I go to a blind pool, typically those lockup periods are 5 years, 7 years, right?
5 to 7 typically.
5 to 7. And with you, I can choose a 6-month option or a 24-month option or whatever it is. And I know that within a certain level of confidence that at the end of that 6 months, the property is going to pay off or be refinanced. I'm going to have my money back. Then I can take the money that I've earned from the interest that's accrued, reinvest that into another deal, and do it all over, rinse and repeat.
Absolutely. Absolutely. And that's the short-term aspect. One of our kind of catchphrases is short-term investments for long-term investors. It gives them the advantage of liquidity, allows them to move in and out of the market completely if they want to, or in and out of different aspects of real estate. There's different times in which construction is the best place to be. There's other times where medical office is the best place to be, or commercial versus residential. And because of the short-term aspect, you can kind of dictate where your money's going instead of putting it in for 5 to 7 years and hoping that things will be good during that entire duration. And most specifically, at the very end of that, when your money is able to be recapitalized and taken out. So you've got to hope that you picked a good horse for 5 to 7 years. Here, the horse you're picking is one you are specifically picking and one in which will be much shorter than that.
Completely. And I think that goes back to kind of the beauty of your expertise and being able to underwrite all the different asset classes that are involved in real estate. Like you said earlier, like if it involves real estate, I can try to figure out how to understand it and figure out if it's a good deal or not. One thing that you need to be aware of as an investor is that a lot of these funds are very specific towards the asset. Multifamily fund, commercial office fund, commercial medical fund, whatever, right? And the reason it's the same company, but I've got 15 different funds under that company that are acute towards that asset class, right? That's also very dangerous because if you pick the right horse, you could make a ton of money. But God forbid you go into multifamily, right? Where that was a great fund at 3.5%, right? And HUD housing and FHA rates were at 2.75 or whatever now, right? As an investor, you need to understand the cap rate value of that property, right? Cap rates are always trading at its best when interest rates are low. So when interest rates adjust and you're stuck in that multifamily fund where now your cap rate loses all of its intrinsic value in that property, you're stuck holding that fund for the 7 years and delay and pray interest rates better come back down, right? So your ability to navigate that, have the shorter time horizons. How many multifamily deals are you doing right now?
Not many. And the reason behind it is it just doesn't make economic sense. If it doesn't make pennies, it won't make sense. And right now, given the interest rate environment we're in and the cost to construct, it just isn't making sense. And because of that, our portfolio has definitely shifted away from multifamily. No matter the stage of the life cycle, whether that is the acquisition of raw land, the entitlement of land, the development of it, or the vertical construction of it, we have definitely moved away from it. And we'll continue to do so for the foreseeable future until the economics of it start to come more in line with reality.
Sure. So if I'm an investor, I'm looking at, okay, well, how many REITs or specialized funds have suspended their dividend? I still want to have some sort of allocation and risk in real estate because, historically it's been the number one wealth builder for people ever. No, you've never created more wealth through real estate than any other asset class. So I still want some exposure. How do people reach out to Ignite Funding? How do people find you? And how do I sign up to become an investor?
Right now, most of our investors just come from word of mouth. Investors that are with us right now refer their family and friends and get on that way. We do advertise in different publications. We do have our own podcast called Deeds in the Desert, specialize in educating soon to be real estate investors into the industry, into different markets. Obviously, this is our home. This is where we operate out of here in Las Vegas, and one in which we have a large percentage of our portfolio because it's a market that has a lot of people moving to it and has great drivers of economic expansion in the future. So Deeds in the Desert, great way to look us up. Our website, ignitefunding.com, is where you can go get a lot of information. You can look at a plethora of different white papers of what it means to be an investor in real estate. What is hard money lending? What is private lending? Why should you be involved in real estate? Although real estate isn't for everyone, it should be part of almost everyone's allocation or entire portfolio. What that percentage is, we'll leave that up to the individual, but I truly believe everybody should have an allocation towards it.
I'm going to do a little rapid fire questions now. Okay. And you can expand on them a little bit, but I want them to kind of be quick.
Yep.
Right. What is a bold prediction for the outlook on the market in the next 5 years?
Next 5 years, you are going to see reassessment of pricing.
What does that mean?
Well, when you asked or talked about interest rates changing, cap rates also change with interest rates. As we are seeing a new norm, in my prediction, a huge sea change, one in which hasn't happened in quite some time, where the normal interest rate on your home loan is 6%. Interest rate drives valuation, property valuations through cap rates. When interest rates readjust, as I truly believe they have, asset values will need to readjust as well. And we haven't seen that reckoning yet. And I do think it's coming.
You think it's going to be adjusted down?
Absolutely.
Okay. Because my first thought when you said that was that cap rate values are going to be readjusted because the asset itself is going to continue to be something where people want to allocate money to regardless of the interest rate. So you're saying that you're going to see a readjustment on potentially lower values?
Absolutely.
Okay. Number two, what is a book or movie that you have read or seen in your life that changed your life? And how did it change it?
The one that changed my life more than anything is one that most people have heard of, Rich Dad, Poor Dad. It's one that really changed my perception on things and it really skewed my way of looking at the long term. Real estate is not for the short man. It's a long man's game. It's one that if you're trying to get rich overnight, you're probably in the wrong industry. But if you want to build generational wealth and if you want to get involved with long-term, historically fairly stable assets, it's a great marketplace to be.
Fed rate cut in the next 12 months, yes or no?
Absolutely. And I hesitate to say absolutely. There's nothing in this world that is absolute except death and taxes. But an interest rate cut from the Fed in the next 12 months would be number 3 on my list of the most likely scenarios.
Why do you think that is? Well, I'm in disagreement with you on this, so I'm interested in your. I actually don't think the Fed. I think if the Fed does cut rates, one, I don't think it's the right decision. But two, I think that they're under a tremendous amount of pressure to cut rates, regardless of the data that would not support that. So I'd be really interested going into an election year with what's shifted politically, if they would actually even do that.
Well, I don't know how much time you want me to get into this, but this one that I think people love to talk about, but very few people truly understand the economics behind it. If you look at what the Fed uses for their data points are obviously historical data. Even if it's yesterday's
it's in arrears.
Data, it's always in arrears. Yeah. And how far in arrears? If you look at most of the inflation, where it's coming from has been on the real estate side of things, pricing pressures from that. That data is nearly a year in arrears. What is not that far in the past is other data points, what you can get from apartments.com. You can get it from other areas and see shifts of asking rents. So once that data starts to come in, and it has started to and will continue to do so, you'll see a shift in that. The Fed has a dual mandate now. They have to stabilize stabilize inflation, keep inflation under control, and keep unemployment low. Those are a dual mandate from the Fed now. We've already seen an uptick of the unemployment. Don't get me started on why that is all bogus as well. Yeah. I think the real unemployment rate is much higher than what you see right now for a multitude of reasons that we can get into if you like. But I do believe we are moving up on the employment side, and inflation has started to come down. People say the last mile is the hardest one to get to, and although I don't disagree with them, I do see those signs have already taken place. And because of the data coming in, historical data coming back to us, I think we'll start to see even more so in the future.
Yeah, that'll provide them the window that they need to adjust the rate.
I think they already have that window right now because of the dual mandate. Not necessarily just because of the inflation side, which has come down, but the dual mandate of the employment side, we're starting to see it tick up. And I think you're going to start seeing it tick up a lot more. What the employment side doesn't take into account is people in this new gig economy, one that are taking multiple jobs. Because of the way the surveys work, they can be double counted, and right. They are double
or triple counted, or
whatever the number is. Yeah, however many jobs you have, you could be counted more than once. And because of the environment that we're in, a lot of people have multiple jobs and therefore are counted. So I think the real unemployment rate is much higher than it currently shows. And the reason why people's perception of the economy is much different than the reality of the numbers right now, because people have to work multiple jobs to get where they were previously.
Yeah. All right. Last question. There's been a lot of chatter, and this is a fascinating predicament that I'm in as someone that owns, a lot of rental property and that develops rental property, right? But on the Democratic side, there's been a lot of talk about penalties for people that own rental housing to increase their rents by more than 5%. But what they're not talking about is that they also have legislation to provide rent assistance for people, I think, making up to $150,000 a year, right? What are your thoughts on that as an economic strategy? And if that comes to pass, what it's going to do to the market?
I never think rent controls or the government get involved in any way, shape, or form is the right answer. So I'll start by saying that. Yeah. As far as how it's going to work its way into the overall real estate spectrum is yet to be seen. Obviously, this is new legislation that's just being talked about right now, and for the most part hasn't even been enacted. So I don't believe it to be the right solution. I don't believe it to be the answer going forward. How will it affect us? I'm not quite sure, but I do know one thing, and that is, historically speaking, the best builder of generational wealth has come through real estate. And even if these were to come into place, I don't foresee that changing. I think it'll change how it affects you on a very short-term basis. But over the long term, I still think it's a great place to be.
I do too. I think that if you are expecting the historical data, so shelter costs is what the metric is in inflation data that covers housing, and that's the main driver for keeping inflation high, right? And that number's starting to come down because it's in arrears, right? I think that if you subsidize rent, and as we've seen before with college, you subsidize college tuition, it goes from $12,000 a year to $40,000 a year. Why is that? Because you're getting the full faith in government full faith from the federal government. They're going to pay the bill. So jack up pricing, it makes the market completely inefficient. If you subsidize rent for $150,000 income earners, which is like in the top, 80% of income earners or higher in the United States, $150,000 is well above the average household income in the United States. And they're pitching it as, well, we're capping their ability to increase rents by 5%. You know how astronomically high that is? That if I increase my rents 4.9% every year for 10 years and I get it subsidized by the federal government, what my cap rates, I'll make more money than I've ever made in my entire life because the federal government got involved in an otherwise efficient marketplace. So I think it's going to have the opposite of the intended effect. And I think that blows your shelter costs idea out of the water, that if that passes, our inflation and shelter costs is going to be at an all-time high if it's a national mandate.
I guess we'll see, right? We'll see what happens. Shelter costs do make up the largest component of inflation readings. And if indeed you are correct, then your assertion of no federal funds decrease in rates over the next 12 months would come to fruition. I just don't foresee that happening.
Yeah, it's a long shot, but I said bold prediction. You're taking 85% of the marketplace is predicting an interest rate decrease.
Well, I mean, it's easy to say right now, right? Hindsight's 2020. But if we recorded this a year ago, in which we have, I would have said then, and I did say there'd be 2 rate cuts, as opposed to the 8 people were predicting.
Right.
There hasn't been any yet, and I still believe there will be 2 rate cuts this year.
You think 2 this year?
I do think 2 this year.
September? Well, September's the next Fed meeting, right?
Yep. I think it's going to be very hard because of the election this year. I hesitate to say they'll do anything before the election, but for me to hit my 2, they have to, or almost have to. So it'll be close, but I'm still sticking to my 2 for this year. And next year, I do believe there'll be 2 more.
I will give you credit for that. You have been consistent with the 2 rate decreases, and you have not faltered one way or the other. So I'll give you credit.
It's the long man's game, right? That's why we're in real estate. Although things change on the short term, new data points come in. I think the Fed is trying to navigate through using the stars to navigate at night when they've got a GPS with more real-time data and won't utilize that GPS reading and are still trying to point out the Northern Star and how we're going to go to get past the Big Dipper. I think although it can work, and it does, it is very inefficient to do it that way. And the new, more sophisticated GPS system or real-time readings will enable us to navigate a little bit better. That's why I believe there will be 2 this year and will be 2 in 2025.
Yeah. I mean, the most efficient thing to do is have a living, breathing interest rate that adjusts every day. And is not controlled by federal policy. It's controlled by the marketplace and let it do its job. I think, doesn't LIBOR work like that?
I'm not sure
it's an open market rate.
LIBOR works.
Right? I don't think anyone sets a policy for it. I think it reacts to the market. It's either LIBOR or one or the other. I'll look it up for you guys. Pat, thank you so much for taking time away from your family and doing this. We'll have to do it again. Ignitefunding.com if you want to get in touch with Pat's company and find out a little bit more about how trust deed investing operates. And this has been Anyone Have a Pencil. Thank you.
My pleasure.